Then you have positive adjustments, which is your CapEx every year. Then you have your negative adjustments, and this is the account that we're looking at in particular here is called purchase investment. So we're subtracting depreciation, and then we have our ending balance. So year 0. Well, we have the investment plus we have the 54,540,000. The beginning balance was 0. No CapEx, no depreciation. This is just at the end of the year. And then the balance, the ending balance is the sum of all these. So the beginning balance of year 1 is the ending balance of year 0. We do not make any more original investment, but we do have some CapEx. So our CapEx assumption is that we have 300 units, and then we have CapEx per unit, 500, right? So total annual CapEx, this is every year, it's going to be 300 times 500, 150,000. So to our beginning balance, we have to make a positive adjustment for CapEx of 150,000. But we need to depreciate both the beginning balance of the original investment and the CapEx. So this is how that works. So we have original investment. So we have another schedule below purchase investment, right, which is called depreciation schedule. So in year 0, we don't amortize anything, or we don't depreciate anything, excuse me. And what do we say? We have 30-year useful life on the original investment, so depreciation assumptions. Property useful life, 30 annual depreciation, straight line. So straight line just means the depreciation is the same every year. You just take the original amount, 54, and you divide by 30. There are different methods for how you depreciate things, but to make it simple, we're just going to assume every single year 1.8 million, 1.8 million, 1.8 million, right? Okay, so we've got 1.8 million with the original investment. Then we have CapEx year 1. Okay? So I think they said the CapEx useful life is 7 years. And that makes sense, right? Because CapEx is smaller than buying a whole property, so you're gonna depreciate that faster over a course of 7 years instead of 30. So in year 1, we spent 150 million of CapEx, 150,000 CapEx, excuse me, and of that 150,000, we're going to depreciate right away at year 1, 175. Now see what I'll do here. I'll do this CapEx year 2, CapEx year 3. So these are the as I'm going down, original investment, CapEx year 1, CapEx year 2, CapEx year 3. These are the amounts you're spending in each of the years. So total depreciation. So our total depreciation for year 1 is 1.839 million. it's composed of the depreciation on the original investment and the depreciation on the capex that we spent here of 150. So now this becomes a negative adjustment to our purchase investment of 1.839 million, and our ending balance is now 52.8 million. So we went from an ending balance of 54.5 to 52.8. It's because even though we increased the value of our investment by 150, it depreciated faster than we increased the value of it, and it depreciated by this amount. Now we're only looking at this for 4 years, but I just want to show you guys how this works. If you look at this on a couple of sequential years. So we said that this is straight line. So every year for 30 years, we're going to have this original investment being depreciated down. But this capex or year. The capex only gets depreciated down for 7 years. So we've got 1, 2, 3, 4, 5, 6, 7. And what we see is when we sum this, these 7 years, that equals 150,000. So in year 7, that capex that we spent in year 1 is depreciated down to nothing. So it gets a little bit smaller every year until you reach year 7, and then this is 0. So what happens in year 2? So in year 2, again, your beginning balance of year 2 is your ending balance of year 1. You did not make another original investment, so that's 0. You spent another 150,000 on capex, which you're going to have to depreciate again. So we're going to have to take this 150,000, depreciate it down to nothing over the course of 7 years. So you see what happens? So every year you add additional capex here. You have to start the clock on the depreciation again. So this row of depreciation, capex year 1, is associated with this original investment. Year 2, when we make another investment of 150, that's an entirely new depreciation. So we start another row, capex year 2, carry it all the way across. And then what you see is as you go out, it starts to accumulate, right? So not only do you have depreciation on year 1, you also have depreciation on year 2. So our depreciation as we go out in time is getting higher because we're spending more money on capex. So in year 2, depreciation is a little bit higher, 1860, and as a result, now the ending balance of our purchase investment is decreasing at a faster rate because now we have to account for 2 different sets of capex that we're depreciating to nothing. And the depreciation is based on the fact that over an asset's useful life, it's going to become less and less valuable, right? And so it's an incentive for you to invest because you're allowed to, in effect, on your taxes, offset the value that you're losing from your asset becoming less valuable on your taxes. So you're able to take depreciation expense and reduce your net operating income by depreciation expense, like we saw earlier, and that will incentivize you to make investments. Because if you're not able to reduce your income by this is a substantial amount, you'd pay a heavy tax burden, and you wouldn't be incentivized to invest in upgrading your property with a new pool, a new roof, new sustainability measures, stuff like that.
But does it not affect the the sale price? Like when you actually want to sell
It will affect the amount of cash proceeds you get in the settlement statement, because even though you're allowed to deduct this on your income taxes, during over the course that you're operating the property, this amount gets lower, and then we can actually do this next. So the amount that is different between the sale price and this is called book value, is your gain. And the government taxes the gain, but they tax it at a lower rate than ordinary income. So it's favorable treatment. We can do that next too, if you want to do that. So this is CapEx, depreciation. The important thing to note here is that CapEx is a positive adjustment to your investment, and depreciation is a negative adjustment. And so if you know what you're starting with, and you know the CapEx and the depreciation assumptions, you can forecast what you'll end up with. That's what we did here. And just to continue this, I'll do one more year. So if you had $150,000 of CapEx in year 3, same thing. Oops. And since we don't go past year 8, it would go past year 8, but so this would get a little bit more. And the difference in each year is just the additional impact of that CapEx. So this is going up by 429 each year. Does that make sense? Sometimes they call this a depreciation waterfall because, whoops. Because each year you're adding a little bit and it's accumulating. And it just kind of looks like a waterfall, right? So there's nothing in these years, but it just keeps, it's just like a snowball. It keeps growing. Okay. So, save this. So your question was, if this is going down, like when we go to sell a property, isn't it going to be worth less? So I would refer you first to the settlement statement. Did he provide the settlement statement solution? Okay, settlement statement. Okay. Yes, he did. Okay. So the settlement statement is, as a developer, is how you determine how much money that you're going to take home at the end of the day. Because you're going to sell this property for a headline price, but you're not going to be able to take home all of that money. You have to pay other parties that are involved with the sale. So NOI in year 1, this is something we already know how to do, but I'm just going to do it just for the sake of review. But so NOI year 1 is 3301, 138. And we're given a cap rate of 5%. The cap rate is going to come from comparable properties. So like a broker will take a look at other properties that have recently sold, and they're going to be able to compute, what was the cap rate? How much money did it sell for? And then other buyers are just going to know, they're just going to intuitively know like what properties in the market are trading for. So that's how he came to this cap rate of 5%. In reality, today, it's much lower, which is reflective of how much competition there is for assets. So it's a little counterintuitive. So when a cap rate goes up, that means the value of the property goes down, right? Because if your property is worth, say it's worth $100 million, and we're making $5 million of NOI. Oops. Value, NOI, cap rate. So that's 5% cap. Call it 5 cap. So say your property is still making $5 million, but the value dropped for whatever reason. The market softened. Recession. Cap rate is now 6.3. So you just have to understand when a cap rate goes up, that means the property value went down. In this case, it went down by $20 million. Similarly, if the cap rate were to go down, that means your property value is going up. So when cap rates are compressing or going down, that's a good thing for us as you're a developer, if you own a property owner. So our property value went up to 120. Suddenly, we're paying a 4 cap. So just something to keep in mind. It's a little counterintuitive. It took me a long time to get used to that because I was used to this world where you're thinking about things in terms of multiple of earnings, and when you pay a higher multiple for earnings, that just means you value those earnings more. But this is a little bit. This is still like an earnings measure because we're looking at NOI, but instead of it be going up to make more value, it actually goes down. So just something to keep in mind. So, okay. So that means we know that our value at sale equals NOI divided by cap rate. This is just the hallmark formula of real estate, right? Going back and forth between all these things. So that means the headline purchase price of the asset is going to be $66,022,000. We call that the gross sales value because nothing's been taken out of it yet. It's gross. Okay. We're not taking into account taxes. But if we were, this is how you would deal with it, right? So, gross sale value less book value. Our book value at the end of year 1 was, as we calculated here, 52, right? Book value is your original investment, plus taking into account all the capex that you put into it, and also depreciation. So we can call this ending balance / book value. And this is gain on sale. So the amount of money that the gross sale value exceeded the book value by, oops, sorry, this should be negative. It's $13 million. It's called gain on sale. Then what we do is we have to pay a capital gains tax of 20%. So capital gains dollars is going to be 20% of the gain. So if we were thinking about taxes, we're not in this case, so this is just for your own information. If we were thinking about taxes, that's when book value comes into play. It's the spread. It's the difference between your gross sale value and your book value. This number takes into account all your capex and your depreciation to account for this gain. And then we've got to pay tax on 20% of the gain to the tune of $2.6 million. That would eat into our gross sale value of $66 million, but we don't have to deal with that. So I'm just going to say FYI, FYI, tax calc. For our purposes, the only thing that we have to worry about at the end, when we sell this building, we're not. So when you sell a building, that generally triggers you have to retire the outstanding debt at the time of sale. There are certain cases where the buyer can assume your mortgage, and you can just walk into it and they don't have to retire it. But in this case, we're retiring the debt. And that would just result in a less cash to you because they're the same. Debt plus equity equals gross sale value. But so in this case, at the end of year one, our debt has been reduced down to $31.7 million. So we have to pay that back to the bank. But we also generated cash during the year